Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC and the fact that they have raised the Fed funds rate another 25 basis points to get us to 5%. Following that, we're going to talk a little bit about exactly what Powell said during the press conference. We'll look at the summary of economic projections. And of course, at the end, we will speculate somewhat dubiously on the implications for risk assets, namely Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So this sort of completes a journey that we started a long time ago. If you remember, when they first started raising rates, we suggested that the 4 to 5% range is likely where they were going to end up. And then a few months into the rate hiking cycle, with inflation just continuing to run rampant, we revised that to say, all right, it actually seems like at least 5% is where the Fed funds rate will ultimately go. And despite a lot of criticism for something like that, due to whether the debt to GDP argument or the inability to service the debt argument, whatever it might be, here we are in March 2023 with the Fed funds rate at 5%. So I think one of the things that often gets overlooked is that people might look at the context of recent history to say that the Fed can't go above 2-3% because they don't normally do that. But if you look at periods of high inflation, this blue line shows you headline CPI, you can see that interest rates tend to go much higher. Okay, so you have to compare apples to apples, right? You can't compare one business cycle that does not include high inflation to one that does. So it is interesting now that we've made it to 5%, and I will be pretty clear and pretty transparent about my expectations, but I want to be upfront. Now that we're at 5%, I don't really see them going much higher, but I also want to say as well, I think there is more uncertainty now in exactly how high they'll go than there was before, and I think you could hear it in Powell's voice today. He seemed somewhat dejected to some degree. But I think there's a lot of uncertainty. Some of that is due to, actually a lot of it is due to what happened recently with Silicon Valley Bank, and the tightening of the credit market is of course going to lead to a lag on real GDP, which Powell discussed. And because of this, he even said that you could think about that, the tightening up in credit, as akin to an interest rate hike, which is interesting that he said that. But again, we find ourselves at 5%. So then what are the expectations going forward from here? Well, I'll tell you my expectation. Now that we're at 5%, I'm just going to say, hey, like maybe it's going to go a little bit higher, but I'm not really that convinced. Okay, I do think that they're either at the terminal rate, or maybe you get one more 25 basis point rate hike, 2 at the most. Okay, so I think the max that the Fed can go this year is 5.5. That's the absolute max. But if I'm being honest, I don't really think they're going to make it that high. It's possible, so I don't want to count it out, but I don't think they're going to make it that high, simply because it does seem like there are cracks starting to show within the economy. Some of the things that Powell said that I think we should at least review a little bit. Well, the first thing he came out and said was he assured people that the banking system is safe and sound. And then he talked a little bit about that, which of course everyone was going to want to hear about. But he did, again, commit to returning inflation back down to the 2% objective. He said that multiple times. He said that the banking system is sound and safe. But he also said that participants don't see rate cuts this year, which is very much in disagreement with what the market is currently suggesting. So the market still sees a rate cut in July. Now, going into the FOMC, I think the market saw a rate cut in June. So Powell's comment of market participants don't see, or sorry, not market participants, just participants of the FOMC, they don't see rate cuts this year. It essentially just moved this probability of a cutout one more month. So the market still doesn't buy it. But you can see right now that the most likely path is just to sit at 5%, 5% for the Fed funds rate for the next couple of months. And I will say that, at this point, it is subject to change, of course. But at this point, going into sort of the next month and a half, I'm going to say that my base case is that they're done. That's my base case at this point, is that they're done raising rates. I do think they will, of course, continue quantitative tightening in the sense of rolling off assets from the balance sheet. But in the sense of raising rates, I think the Fed has reached the terminal rate. And if it's not the terminal rate, I think the terminal rate is only going to be 25 to 50 basis points higher. Okay, so I also think we're at the point where it's not going to make a huge difference if it's another 25 or not. But I do think there's at least some reason to believe that 5% is in fact the terminal rate. The reason we might change our view on that is when we get more inflation data and how we see how markets respond. So if financial markets start to take back off again, and it seems like everything's running well in the banking sector and we're not having any more issues, and if inflation is still coming in hot, then I suppose we should prepare ourselves for another 25 basis point rate hike. But if the market deteriorates from here, I think they're done. That's currently where I stand. So we'll talk a little bit more about that later on. But I did at least want to provide some transparency to my thoughts on that, especially considering that we finally made it to 5%, which was a target we put out like a year ago, I believe. Now, from there, I wanted to draw your attention to some nuances in some of the things they said. If you go back to the press release in February, so this is not for this meeting, it's for the meeting before, they said that the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So keep these words in your mind. Will the committee, that they anticipate that ongoing increases in the target range will be appropriate? Now read this one, the one from today. The committee anticipates that some additional policy firming may be appropriate. So there is a sort of an attitude change there about exactly where they're going to head. I mean, you can call it a pivot to not a pivot back to QE, but at least a potential pivot in some of the terminology that they're using. So it does seem like we're making it further into this cycle pretty quickly, actually. So that is one thing. Another thing to notice, in the last report, they said inflation has eased somewhat, but remains elevated. In this report, they just said inflation remains elevated. Okay, it's not an oversight. Okay, in the press conference, of course, he did say that inflation was going in the right direction. But just like recently, Powell was giving testimony in front of Congress, and he said that some of the inflation readings that made them believe that disinflation was already here in a very sustained way was revised away. Like some of that data was actually revised away, and it wasn't coming down nearly as quickly as they thought. Now, he sort of walked that back during the press conference and said that they do still see inflation coming back down, but it is true that it remains stickier in some areas. Now, there has been an ongoing debate for some reason. I'm not really sure why, and at this point, I'm almost too afraid to ask. But there's been an ongoing debate about whether we're going to have hyperinflation later on this year. But I would argue that we're much more likely to have rapid disinflation during the second half of this year than we are to have hyperinflation. I don't think that tightening in the credit market, like I don't think that with tightening in the credit market, I don't think you're going to see the necessary demand that's going to lead to hyperinflation. Okay, if credit conditions in general are getting worse, banks are going to be a lot more stringent, I believe, with who they give money to, how they lend it out, et cetera, especially with the recent events that have unfolded. So I think it's probably more likely that we're going to see rapid disinflation in the second half of this year than we are to see hyperinflation. And the recession word did come up during the meeting. Powell did say recessions tend to be nonlinear. Someone asked Powell if the path to a soft landing still exists. And I got to say, it seemed like he was dodging the question for a while. But he did eventually say that he thinks the pathway still exists. But I didn't necessarily sense the confidence when he said it. I do think there was some level of dejection just in the fact that the banking, there was this issue in the banking sector while inflation still remains relatively high. And while the labor market remains secularly tight, I mean, it makes his job very difficult because, there's on one hand, you want to lower inflation, but on the other hand, you have cracks showing up in the banking sector. Okay, and so it's a tough balancing act. And I'm not saying that the path is necessarily obvious. I'm sure that they will try to figure it out as they go. But, with all this in mind, I think we have to be open-minded to the idea that no one exactly, of course, is going to know where the terminal rate is. I certainly don't, but I did say a long time ago that I thought 5% was a realistic target for them to hit. Now that we're here, I'm not really sure how much higher they can go. Now, if you go look at the summary of economic projections, if you look at the dot plot, you can see that, year in 2023, again, the market participants are saying, look, it's probably going to be above 5%. There's one person here below 5%, but in general, they're not seeing rate cuts this year. Okay, and there's some participants that still see the Fed going higher than where they are now. There's a few up here that are still calling for 5.5% by the end of the year. Okay, so there's definitely a chance they could make it one or two more 25 basis point rate hikes, but I think they're really pushing it at this point. What I also found interesting is sort of just how far the spread is here in 2025. I mean, there's someone down here that has, a projection at, around 2.3, 2.4% or so. But then there's someone all the way up here above 5.5%. So there's a huge spread here on what they actually think is going to happen. And in fact, the spread in 2024 is quite significant as well. With all that in mind, I think it does show there certainly is a large level of uncertainty going into the rest of this year. Even though Powell says they don't expect rate cuts, the market simply doesn't believe him. And to be completely honest, why should the market believe them? If you rewind the tape here a couple years ago, it's not like anyone in the Fed was calling for rate hikes to 5%, right? I mean, that was unheard of. The idea that they would even go above 2 or 3%. So I don't really think you can blame the market for not believing the Fed, because at the end of the day, if there's a major meltdown somewhere in the financial sector or wherever it might be, and if you see a massive sell-off in risk assets, I think they would cut at that point. And I think in that though, you might say, well, if they cut, wouldn't that lead to inflation coming back? Well, yeah, it probably would. The other side of it, though, is what would likely make them to cut would be a recession, and recessions are pretty notorious for at least having a good, being somewhat impactful in bringing inflation back down to earth. So a lot of things to consider there, but I did at least want to provide some commentary on where the Fed funds rate is. They're now at 5%. It's been our target for a long time. Will they go a bit higher? I'm honestly not convinced. I think for me to be convinced that they're going to go higher than 5%, I would need to see inflation data come in pretty hot at the next report. But if it doesn't come in hot and we continue to sort of see risk assets sell off, then I think they're just going to stick with 5%. Now, speaking of risk assets, I suppose we should come check in on the markets over here. So first, we'll go check in on the S&P 500. There actually wasn't a whole lot of intraday volatility. I mean, there was some, but not as much as I think maybe a lot of people were expecting. But I mean, at the end of the day, it did sell off by about 1.5%. I mean, this was at the very end of the day. So, during most of the day, it was, the S&P was mostly just around 4,000, and that there was a huge sell-off going into just the final minutes of the day. And you can see that I believe we're right back around that 200-day moving average. So you can see the S&P 500 closed at 39.36. The 200-day SMA is at 39.34. So it's currently sitting just above the 200-day SMA. Of course, it'll be interesting to see as we get further on into this week if the S&P can hold above this level or not. I think if it doesn't, it's probably because the market is starting to price in a recession. If it does rally off this, then I imagine the market is sort of saying, hey, yeah, the collapse in the banking sector, the collapse of Silicon Valley Bank is bad, but perhaps it's not going to create a ripple effect throughout various sectors. But again, we saw a sell-off here in the S&P 500, so about down 1.5%. Bitcoin, let me go check. I'm not even sure where Bitcoin is at right now. So Bitcoin is currently at 27K. Note that it's well above its 200-day moving average. The 200-day SMA for Bitcoin actually sits all the way back down at 20,000. So quite a big difference between where the S&P is with respect to its 200-day SMA and where Bitcoin is with respect to its 200-day SMA. Now, one thing that I wanted to explore just somewhat briefly, and admittedly it hasn't really been my base case. We mentioned it one time in the past, but if you look at interest rates in general, if you look at interest rates in general, and let me flip this over to the to a weekly time frame here. So if you look at the United States interest rate, one of the things you'll notice is that last cycle we saw Bitcoin hit a bottom when the Fed reached the terminal rate. Okay, now Bitcoin so far has put in this bottom here, right? We're still waiting to know for sure, right? But so far, that's where it occurred, but it's sort of during the middle of the rate hiking cycle. What you'll also notice as well is that during the rate cuts, that's when Bitcoin started to come back down. So you'll notice, right? Rate reaching the terminal rate, that's where Bitcoin bottomed. Starting to cut rates is where Bitcoin started to come back down. Like, so rate cut started here in, June, July, and that's where Bitcoin really topped out and started to come back down. Now, I would put forth this idea, and again, it hasn't really been my base case, but it's a case that I think we should at least consider, is, what happens if they're just so far behind the curve that everything's being delayed by, one major pivot. So let me explain what I mean. The Fed during the last cycle, they were hiking rates during the bull run. Okay, they were hiking rates during the bull run. And they continued hiking rates even through the bear market, and the end of the rate hikes marked the bottom for Bitcoin. But it wasn't until they reached the terminal rate. But note, they started hiking rates in the bull market. Some have argued that the shift from 75 basis points to 50 basis points could have been interpreted more as the pivot, right? So if you treat that as the pivot instead of reaching the terminal rate, then you could argue that once the terminal rate is reached, that might mark a similar type of thing as what marked it with rate cuts last cycle. So by the time they actually cut rates, perhaps everything's already been priced in, and then we'll just continue on into the next bull market. But I did think that was at least one interesting way to look at this. So I think the only question in my mind, though, is there's really no guarantee that they've reached the terminal rate yet. So if they haven't reached the terminal rate, then we don't even yet know if this sort of conclusion is valid at all. But if they have reached the terminal rate, and Bitcoin, if Bitcoin starts to bleed over the next several months after the terminal rate has been reached, right? Like, so if we look back on this time in 3 months and the terminal rate was reached at 5%, and Bitcoin kind of topped out at 28, 29K, then perhaps what the market is looking for at that point would just be when do rate cuts start. And that could sort of help in the bleeding, so to speak. But again, I mean, right now, I mean, I still think there's a lot of uncertainty going on. I have no idea if they're going to go another 25 basis points or not. If they do go another 25 basis points, then we're still sort of kicking the can down the road on this sort of idea anyways. But at least in the short term, it doesn't really seem like risk assets have liked the news. But also in my sort of as we've covered a lot of this stuff, I think what's often more important is let's see what happens tomorrow, because oftentimes there's a reaction and the following day kind of tells you if it was a knee-jerk reaction or if it's really a start of a new trend. So let's see what happens tomorrow before sort of jumping into any conclusions. I mean, I've told you guys my expectations for this year are very tempered. I think it's going to be a relatively choppy year. I know that there's been a lot of excitement recently, and I mean, I'm happy to see it, to be completely honest, because especially with the dominance of Bitcoin going up, mainly because I only have really Bitcoin. I don't really have any altcoins right now. But if we do come back in for a while, it's not to say that Bitcoin can't eventually recover out of it. It's just what I would consider to be a recovery year. Okay, so I would just say it would more so be akin to a recovery year, where we're just going to chop around for a while, wreck both sides, and then eventually we can go back up once we get out of this mess that it seems like we're in. When I was listening to Powell, he certainly seemed somewhat dejected when he was talking. The whole meeting seemed somewhat somber to me. I don't know if it was just me. Maybe leave a comment down below if you also felt like that. But I do think there is some worry that Powell has about the tightening up of credit conditions leading to a lag on real GDP, and obviously if that happens, it can lead to layoffs and it can lead to a recession. So that, I think, is the thing we have to consider. It doesn't mean that, it doesn't necessarily mean anything specific for any individual risk asset, but I think that's ultimately what we're going to be fighting through for the duration of this year is, will we get a soft landing or will we actually go into a recession? And I think that question mark is going to make this year just simply be remembered in general as a recovery year. One thing I would like to remind you, because I think some people have a hard time thinking about even a move like what we saw as sideways, because when you're living through it, it doesn't really feel like, saying that we just go sideways this year and then seeing Bitcoin pump 84% as being reflective of a sideways year. But it always seems more obvious when you're not living through it. For instance, I don't think many people have questioned me calling this a sideways year, right? When we think back to 2015, we look at that and it seems like a relatively sideways year. But if you take a measured move here, if you take a price percent move here from the bottom to the top, it was also about an 80% move. So when you're living through it, it certainly doesn't really feel like it can be sideways. But when you look back on it in history, it could certainly appear to be sideways to people to people out in the future, sort of reflecting back on this time. So that's just of course, just something to think about as we continue to push forward through this cycle. So to sort of finalize here, the Fed raised by 25 basis points. Inflation's still high. They're still remaining committed to getting inflation back down to their 2% objective. They're not actually making any changes to their, the QT side of things, rolling off assets from the balance sheet. That's remaining the same. The Summer of Economic Projections shows that they're not considering rate cuts this year, really. The market says, no, you probably are going to be cutting rates as early as July, and some pretty big rate cuts going into 2024, late 2024 as well. So definitely some disagreement there with the market and what the Federal Reserve is saying. And so if the market does bleed, so if risk assets do bleed, it could be due in part to repricing in higher for longer. Okay, because again, right now, they're not really pricing in higher for longer. They might be pricing in higher because obviously 5% could be considered higher, but staying at 5% for 3 months is not really considered longer. So if the market does bleed, I imagine one narrative to support it would be all of this getting repriced and then not having rate cuts until either the very end of this year or sometime early next year. So again, it's probably somewhat premature to make any clear conclusions just yet because risk assets have sold off a few percent today. But let's see where they come in over the next couple of days, and then of course try to see what that would mean overall for the duration of this year. And of course we talked about a lot before about tools for navigating these phases, and of course you can find those throughout this channel where we talk about various strategies, right? Like dynamic DCA strategies often are suited for recovery years in the long run. But anyways, that'll wrap it up for me. I think we did a pretty good job of covering more or less what happened. So if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.